Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hello, Chris. Good to see you again.
Hello, Lee. Good to be here. Another week, another busy week. Lots of earnings to go through.
Yep, and as always, lots of great talking points. Start off with news from our ultimate stocks portfolio. We've got Apple quarterly results and some incredible share buybacks going on. Starbucks, what's going wrong there? McDonald's, and then we're going to touch on Coca Cola, which isn't an ultimate stock, but is definitely worth a mention. Moving on to the UK large cap news, we're going to discuss Whitbread and St James's Place and comparisons with Hargreaves Lansdown. Moving on to the UK small caps, Bonkers Bargain James Cropper, Card Factory, HSS Hire, new business model, going to be an interesting one. And then Anexo, which is another interesting conversation. So plenty to discuss. We'll try and get it done in half an hour, but something tells me this might run on a little bit longer than half an hour. What do you think?
Oh, I don't know. We should be able to get through it. Hopefully we can digest things, summarize it down to a palatable amount of time.
So Apple then, share buybacks. What's going on here?
Well, Apple, I mean, it's just staggering. They announced results this week, but you just look at how much they are buying back their shares. They paid $650 billion over the period from 2012 to 2023. To put that into context, that is equivalent to 3 times the UK's largest listed company, AstraZeneca. So they have bought 3 AstraZenecas in the last 11 years. Over its last financial year, they paid out $78 billion in share buybacks. They're buying back their own shares. And that's equivalent to one Diageo. Diageo owns Guinness and countless other brands of a whiskey like Johnny Walker. It's one of the world's biggest spirits companies. So in the year, it buys each year a Diageo. This is just crazy. The latest announcement, they've said now in their results announcement, and their results are a bit better than people are expecting. They've said they've committed to a new share buyback, $110 billion share buyback. This is just beyond anything that anyone has ever seen. They are generating so much cash that they're committing to acquiring their own shares.
It's incredible, first of all, the amount of cash that they're making. It really is. As a fund manager, an experienced fund manager, Chris, do you like to see this? Is this something you like to see, this sort of level of share buyback?
I like to see it when it's well thought out and controlled and has real merit. With Apple, the worry is that they haven't got a better use for their cash. They're lacking ideas. They're lacking potentially innovation. The product launches aren't quite as dynamic and exciting as they used to be. So what do? They increase their dividends marginally, but they reduce their share count as well. Some people may like that if they think their shares are cheap, but they're not even they don't look particularly good value at the moment because they've run up quite highly, the share price. So is this a really good use of their money, their cash? I'm not so sure, but it seems to be the market likes it. The mainly US investor base likes it. Warren Buffett's Berkshire Hathaway, I think he's probably in favor of this. Clearly, the more shares that they buy back from willing sellers, the greater the percentage of the company the remaining shareholders own. So if remaining shareholder doesn't tender their shares, they say, I don't want to sell my shares. Conceivably, they own a lot more of the company in the end and have a greater participation in future dividends. So it's good for existing holders.
Yeah, and probably a higher share price as well. It's worth mentioning as well, this is part of the ultimate stocks portfolio, isn't it, on Investors Champions?
Yeah, we do. And we own it. Our associated business, Fundamental Asset Management, owns it. We've got it on our client portfolios. We're big fans of Apple. Ultimate stocks, we think this is one of the ultimate stocks. And our ultimate stocks portfolio is 30 stocks of high quality companies. And we think Apple is a very high quality business.
The iPhone sales are actually declining, aren't they? They've declined 10.5% this year to 46 billion.
Yeah, they have, yeah. China as well. Big pressure in China because the Chinese government is firmly behind local brands. Huawei has sold a lot more phones. China, they've suffered declines. In the meantime, their services business, Apple services business, all the subscriptions, Apple TV, Apple Pay, etc., it's going great guns. That grew 14% to $24 billion in the quarter. And that's super high margin. They make so much. Their percentage operating margin on their services is huge.
Yeah.
far higher than if they sell phones. But yeah, you're right. The iPhone sales, just common sense. How often are we changing our phones now? What added features do we need to compel us to buy another one?
It's worth mentioning as well, China is the third largest market for Apple as well. Should we move on to Starbucks and a company that's struggling and is your favorite coffee as well?
But like Starbucks, I think they do a good job. The thing I like about Starbucks is often you don't have to wait so long. So many other places, which I won't mention, it seems to take ages. And I'm not a man that likes queuing or waiting. But Starbucks are clearly struggling. The shares fell, biggest fall ever. A daily fall fell 16% on the day of the results. And that's the second time they've had to warn on profits. So it has been an ultimate stock. It's clearly having problems. It's under a newish CEO who's clearly struggling to reinvent things. The founder came back twice, I think, to try and reinvigorate. He stepped aside now to this new person to see if he can get things going again. They've also had problems in Israel. They've got problems with their unions. Inflation, elevated inflation has hurt. It's currently under review in our portfolio. I'm starting to have my doubts. Are we well past peak Starbucks as the growth model now totally hit the buffers? Do they have to really rethink things? It's quite difficult. The market is swamped now with coffee shops. How do you change and make a difference? Again, it's another business under pressure in China. Massive competition in China, which has been a big growth market for them.
What you do see as well is a lot of independent coffee shops popping up as well in towns and
Yeah, and they've all got the best kit in them now as well. They can get going, get up to speed, and people quite like now the personal coffee shop, as long as they can produce them quick enough. So I won't be going in if it takes me I've got to wait for ages to have a coffee.
one place that you don't have to wait long for your food or your drinks is McDonald's, but they are struggling. So we have mentioned these in the past, and it was episode number 5. We did a deep dive onto the business model, wasn't it?
Yeah, they are. It's another business or another well-known franchised operation business. And as you say, we went over their franchise model, which is absolutely brilliant. But yeah, they put through price increases and up their marketing spend, and revenue still increased, but only just in line. And net income was, I think, marginally below Forbes. And they're guiding, saying, look, it's really tough out there. People don't want to pay. And if they don't want to pay for McDonald's, which is about as affordable as you can get, I think, if you want to go out, what do they want to pay for? And so I think it's a big indicator, perhaps, of McDonald's with its very slick system, very tight cost controls, great marketing is struggling. What's the rest of the market really like? Probably struggling a lot more.
It shows that the consumer at the lower end perhaps really are tightening the belt, doesn't it?
Yeah, it does. It does. And this emanates, you've got to look to the States as well. Generally, the States is a great barometer in the US, and it's
That's why I
really,
was thinking that this is probably states driven as well. That the
it is, yeah.
results,
And if it's over there, it'll come over here as well.
yeah.
You can, they're quite a enthusiastic bunch of they're not embracing McDonald's. I think the rest of the world are probably going to suffer as well.
Have you?
But what?
Do you eat McDonald's?
Every so often, it's a treat. My son and
Do,
I go to one as a treat. Yeah, yeah. We
yeah,
like it's a particular stop off, but not very often.
not
I
very
like one
often.
occasionally. Yeah, I do.
Yeah.
Yeah,
What do,
absolutely. Yeah.
what do you think about their latest announcement for improving with the new breakfast line?
I'm not entirely convinced about this one to sell Krispy Kreme donuts across its US restaurants by the end of 2026, which analysts said could boost the chain's breakfast business. You won't see me having a Krispy Kreme donut for breakfast, but whatever floats your boat kind of thing.
Yeah, I think they've probably trended too far to the healthy side, and now they're realizing we need to swing the pendulum back here and
Yeah,
get some sugar on the menu.
yeah, let's get back to the sugar business. That
Yeah,
sells. Sugar sells. We're going to
sugar
win on that
sells.
one. So they're getting Krispy Kremes in. Oh,
Yeah,
well.
actually, that's a really good segue. That because the next product as well is loaded with sugar, Coca Cola.
Yeah, I thought it was worth mentioning. We've got Warren Buffett's Berkshire Hathaway AGM weekend. It's going to be a very big weekend there. The first one without Charlie Munger. So it's a big thing. And Warren Buffett's been a huge supporter of Coca Cola. He's owned the shares for a long time, since, I don't know, the 70s or 80s. Made an absolute fortune out of owning Coke shares. And his face was even featured on the Cherry Coke in China a few years ago, and he's revered in China. So Coke stuck his face on their Cherry Coke because he drinks Cherry Coke. And Berkshire's stake in Coke's worth $25 billion, so and he's the
Wow.
biggest single shareholder. But yeah, what amazed me about the Coke numbers is how can a business like this contrast a little bit with Starbucks and McDonald's, much like the other two? Is it probably the best established of all? Yeah, it goes back a long time, Coca-Cola. but it's grew its revenue 9% organically. I mean, that's pretty good for a mature business, but how
Mm.
did it grow? Effectively, it didn't really sell more of the stuff. It just upped its prices, but nine to cover inflation. 9% growth for a very elderly business like this, I thought was staggering. It's a proof of really the strength of the business that you can lift your prices substantially and people still pay up. They're not worried. Oh, they just pay up for stuff because that's what they want. And as a result, Coke shares have been doing well. They're trading at a higher rating than rival Pepsi. And Pepsi, a lot of the stock market used to prefer Pepsi because it had a more diversified offering. It had food products as well as fizzy drinks or drinks. It's turned around now. People have pushed up that rating of Coca Cola. But yeah, I was staggered about that, how they could still be growing at that kind of rate.
Was that solely then just because they literally just raised the price and people just still carried on buying it in the same numbers?
It
Yeah.
appears so. The talk was that they mainly driven by higher price rises just to help offset the inflationary costs.
So they just passed it on to the consumer then.
They did, yeah. The consumer was happy to pay up.
Yeah. Coca Cola is one that they're not prepared to cut back on.
No.
But McDonald's, it
I'm
seems
happy
they are.
I'm happy to cut back on it, I should add. Yeah. I'm not a big consumer of Coca-Cola.
No, not me, not me. Should we move on to the UK now? And
Yeah.
one of the main topics we wanted to touch on was Premier Inn, owned by Whitbread, and just compare it to Intercontinental Hotels Group, which two very interesting business models, aren't they, Chris? But first of all, Premier Inn. Let's go through the numbers and the business model of Premier Inn first.
Premier Inn is the UK's largest hotel group. It's got approximately 12% market share out of the total room supply in the UK, and it's got there quite quickly. I mean, it's done really well. And as of the end of February, they had 853 hotels and over 85,000 rooms. So it's quite substantial. It's also growing fast in Germany. The whole business is valued at 5.72 billion. The difference with Premier Inn compared to other groups is it does all its own marketing and distribution. You've seen the adverts on TV. So it controls the whole process. You generally book directly with Premier Inn. It just came out with record-beating results for the 12 months to the end of February. Revenue was up 13% to 3 billion. Profits were up 36% to 561 million. So that's a nice margin, 19% margin. So look, it's doing really well. It's lifted its dividend up. Revenue per available room, that's a key measure. These businesses quote this RevPAR, revenue per available room, that rose 10% to £65.56 in the UK. So that's the revenue, the sales room per available room per night. They said that current trading is mixed. The big news with this one, though, they've said that they own the Beefeater chain as well. And they can convert those, as well as other restaurants, into 3,500 rooms. So clearly, some of their restaurants aren't working and they need to make better use of the assets. And this is the point I'm getting to really with hotels. The holiday season's upon us. Well, we've got bank holiday anyway. When you go out to a hotel, who are you actually paying? Who owns the business you're in? If you go to a Premier Inn, they are the owners or the leaseholders of the properties. They're responsible for everything. That's not the same necessarily for every hotel group. It depends who you visit, and they all have different models. Whitbread is also returning a lot of cash to its shareholders, so it makes a lot of cash. We question really whether can it afford to return all that cash. So if you look at Whitbread on its balance sheet, lots of assets, the hotels it owns or the hotels it leases, and against that you have liability, you have the bank debt that it's used to fund these hotels. Also, you have the long-term lease liabilities, what it has to pay over the long term of the lease of these hotels. 56% of their sites are all owned freehold, so they actually own the properties. They've got a valuation as well. But, I look at this, and analysts have said, oh, it's a good quality operator. But really, is it a good quality allocator of capital? Because in owning the assets, it has to deploy an awful lot of its own capital. We compare it to McDonald's. McDonald's necessarily doesn't, it gets other people often to pay up for things. But Whitbread and Premier Inns owns a lot of its assets, and it has the capital commitment then. It's effectively the landlord of them as well. And that really is very different to Intercontinental Hotel Group. Intercontinental Hotel Group made a commitment a long time ago to get out of its assets, to no longer own its assets. So it said Since 2003, we have completed the sale of almost 200 hotels as part of our move. And here's the important thing, to an asset light operating business. So when you say stay in an Intercontinental Hotel, that could be a Holiday Inn, Crown Plaza. They've got so many brands around the world. They own they operate or franchise 6,300 hotels around the world. And of those, 5,300 are franchised. So it's very different. You may be staying in the hotel and you may be paying money over, but it's not necessarily going over to Intercontinental Hotel Group. It might be going to the franchisee who said, hey, I want to run a hotel. Can you help me do it? And all the marketing. I want your systems, Intercontinental or Crown Plaza or Holiday Inn. I'll pay you a franchise fee, but let me go ahead and run the hotel. Or to the same extent, somebody might own that hotel, a different party as well entirely. So
Yeah.
it's very different to Premier Inn. But yeah, I just thought it's fascinating because what it boils down to at the end is if you look at the share price performance of Intercontinental Hotel Group and indeed say Marriott, which is even bigger, which is the world's largest listed hotel company, their share price return has been significantly better than Whitbread stroke Premier Inn over the last 10, 20 years. The operating margins are quite similar. So the operating profit they make is similar, but the return on capital, how much capital each of those businesses have to put in, is very different. Whitbread's return on capital has been sub 10%, whereas IHG, Intercontinental Hotels Group, has been over 40%. And Marriott as well is also quite high. When an analyst says Whitbread is a first-class operator, it may be very good at operating hotels, but is it as good at allocating capital? Is it as good as those other businesses at allocating capital?
Yeah. And in terms of an investment perspective, would you just mind explaining what return on capital means? You mentioned there's sub 10% versus 40%. What's the significance of that? What does that mean?
You should always be looking for a business that can generate a consistently high return on capital. So if, for argument's sake, you had a £10,000 to put into a sweet shop business, and that sweet shop business every year delivered, after all costs and tax, delivered, I don't know, £1,000 from the £10,000 you put into it, money you put into it, all told, you put share capital of 10,000 and you got back £1,000 profit. That will be a 10% return on your capital. It's quite a reasonable return, but not exceptional. Supposing you can find a business that can generate more than £1,000 from the 10,000 you put in, that's going to be far more appealing, isn't it?
Yes.
So you should always really look at what the cash return on capital that can be delivered consistently, because if you can put that to use, consistently generates higher return, and the higher the return, the better.
Yeah.
So it's the effective use of whatever capital you have at your disposal.
So Whitbread's is 10% and IHG 40%.
Yeah, I mean, it's two very different operating models. Bread's Premier Inn model may ultimately turn out to be a good performer. Clearly, the advantage of their business is when business is good and everyone's traveling and they're filling their premises up, they're going to make it a pretty good return because they own the whole system, don't they? They own the distribution, the properties, they're controlling every aspect of it. And to the same extent, IHG, when things are really flying, their franchisees are going to be doing really well. They'll do very well, but the greater return potentially could be with the landlord and the franchisee rather than IHG. The beauty of the IHG model as well is they have a sort of sinking fund, a system fund that all the hotels have to contribute to IHG, which then goes towards supporting marketing and systems development support. So effectively, all that's being paid for by the franchisees or the owners of the properties.
It's like a quasi hotel slash Airbnb model, isn't it? Where essentially it's a quasi platform.
It is, yeah, it is a bit. Other than it's a little bit more in depth because they actually provide all the systems, the wherewithal, the knowledge of the hotel sector, how you run a hotel, and also this marketing support on top of that. But you're right, it's getting closer to which I think is a fabulous business in terms of its potential to return on capital, which is indeed an Airbnb. It's just a great business model, and it's no accident that Airbnb's valuation, we said that, what did we say? Whitbread's value was valued about £5 billion, mostly UK centric, just expanding internationally. How big can Premier Inns get? Could they grow globally, potentially? IHG is sort of 3 times that size. Marriott, 50-odd billion market. Airbnb is currently valued at 80-odd billion pounds. So Airbnb's valuation is getting close to one of our ultimate stocks, actually, Booking.com, the online travel agent. So the market can see, the stock market sees the potential in the Airbnb model. I mean, it's a platform. They've
So
got no sort of hard assets, capital expenditure requirements, have they? Their money is all going into their technology and their systems and, of course, their marketing.
So just let me get that. So Premier Inn or Whitbread, 5.2 billion market cap. And then we've got IHG, 12.8 billion. And then we've got Booking.com and Airbnb up there in 80 plus billion.
You got Booking.com, about 90 odd, online travel agent.
And they all know properties.
No
Other than
properties.
probably the property that they sit in themselves.
Absolutely.
Their headquarters.
Their money is going into systems, marketing, linking everybody together, and they're taking the cut out of it. Airbnb is the most extreme. It's a marketplace of properties. It's got 7 million homes around the world now on its
Right.
books, and it's now adding little features, a guest favorite feature. It's starting to curate things a bit more, isn't it? You go on there now, you can see the ratings, and you're starting to get a feel of what's a better place and what isn't. I've stayed in a few Airbnbs and had different experiences. And the last one was really fantastic.
I know we've moved on a bit there from actually discussing Premier Inn and Whitbread. It's really interesting, the different business models there, isn't it? It really is fascinating, the two very contrasting business
Yeah.
models.
And I don't think it's something that people think about. They stay in a hotel, they don't actually know who they're staying with, really. So they'll stay in a Holiday Inn. They'll think it's Holiday Inn, but it might be owned by, I don't know, a company somewhere else. It might be run by the franchisee, who in turn is paying over his money to Holiday Inn stroke Intercontinental Hotel Group. And the same applies to Marriott as well. Franchising, when you have a great reputation and the wherewithal to do things, is just a brilliant high return operating model. And there are so many great franchise businesses, whether it's McDonald's or Intercontinental Hotel Group.
Yeah. So someone who studied businesses for multiple decades and invests in them, which business model do you prefer then?
I love the franchise model when it works. I think it's absolutely fantastic. I like a business that doesn't have to spend huge amounts on long-term capital assets that may or may not deliver, that require countless amounts of their maintenance and upkeep to keep them spick and span. I prefer, if possible, somebody else to have to worry about that with the deep pockets to do it. So if you can find a franchise business that's proven itself and effective, it's absolutely brilliant. It can just work really, really well.
Yeah, fantastic. Should we move on to St. James's Place?
Yeah, they announced this week, and I think it's worth focusing. They've clearly been in trouble. They're struggling. It's their high price service offering has come under fire, quite rightly. So it's proven to be pretty bad value for money. But their CEO came out with a comment that withdrawals, because they've had a lot of withdrawals, net customer inflows dropped dropped a heck of a lot from the previous quarter. But the CEO made the comment that net offset inflows, they remain at an elevated level, reflecting wider industry trends as clients draw upon their savings to meet continued financial needs. And it's ironic, in the same week that St. James's Place announced, Hargreaves Lansdown actually announced a record new 34,000 net new clients, up 48% year on year. And one of St. James's Place rivals, Quilter, reported an increase in net inflows of money as well. This contradicts what St. James's Place was saying. It's a wider industry trend. Some of these other industry players, and Hargreaves is a DIY-based investor platform, are seeing positives lately. And Hargreaves has had its own problems. It hasn't had an easy time. But yeah, as the penny dropped with people, they don't have to go to an expensive service like St. James's Place. That a lot of their basic investment needs they can do it themselves. DIY platform, cheap, low cost funds as well. They're going to generate better returns than going to a St. James's Place model.
Yeah, I think it's an accumulation of multiple trends all converging at the same time, isn't it?
Yeah, I think so. It's all out there. And
Yeah.
it's rare that things can get too complicated. And when they do, take some good advice off a good advisor, financial advisor, or one-off advice, but stick with those low-cost products. Can't go wrong, really.
Should we move on to some AIM and small caps?
Yeah, the bit that we're probably more excited about often. I thought I'd draw attention to one of our bonkers bargains, a business called James Cropper. It has come a bit of a cropper, James Cropper. It's an advanced materials and paper products group, and I think its headquarters isn't far from you.
Yes, it is. It's roughly about 40 minutes away, Kendall, 45 minutes. So I could quite comfortably attend the AGM and be home
Yeah,
in time for lunch.
yeah, brilliant. Well, it's been a lovely part of the world, so it'll be a good AGM to
Yeah,
attend. Lovely
great.
part of the world. But it has its history in the paper business. Been around since 1845 when Mr. James Cropper acquired the lease of a mill. But really, this is a. I'd implore you to read our in-depth note on a business champion. This is a business that has one absolutely brilliant business in it. It's a listed company with two very different businesses. One is brilliant, and the other one is rubbish. The paper business probably has little interest to people. I mean, it produces lovely paper, but from an investor perspective, it's not exactly a growth market. However, its advanced materials business is absolutely brilliant. And why is it a bonkers bargain? Because we think the value of the advanced materials business is multiples greater than the current market capitalization of the listed group. It's just shame that they haven't been able to extract one from the other. But read our in-depth note to find out more.
Yeah. Have you ever considered becoming an activist investor, Chris?
There is interesting point. I like to invest in companies that are good businesses and avoid the activism bit. However, it's a very good question for James Cropper because unfortunately it'll be a hard one for activists because 38% of the business is still controlled by the Cropper family. So
Mm.
you aren't going to really get very far. And is that a stumbling block to this business really extracting value for shareholders? The Cropper family too wedded still to the paper side and they want to protect it.
Yeah, and traditionally in the smaller cap universe, usually private investors look for family-run businesses, don't they? Or at least founder-led businesses as well. So perhaps maybe this is one at the opposite end of the scale where it's actually holding it back.
It is possibly holding it back. I'm sure it's been considered. Maybe it's too complicated. Maybe it's difficult. There is a pension deficit with this business because it's been around for so long. But I find it really frustrating because it's got a fabulous business in there that if it could be unleashed, could do, I think, really well. It's getting a lot of parent company support. But the entirety, the listed group is really getting weighed down, has been weighed down by the paper side. But yeah, a shame.
Yeah, looks an interesting one anyway. Card Factory looks cracking value, but is it a value trap?
Who knows? I don't know. I think it came out with great results, a great little business. It's again went through some tough times, but it's pretty big now. I didn't realize it had over 1,000 stores in the UK, which is quite a lot. And it does a really good job. I think it's a great place to go. We've got one near to us here. Good service, great, well-priced products. Clearly appeals in the current sort of consumer environment where people don't pay too much. It's seen off Clinton cards, I think, several times. It also prints a lot of its own cards as well. Profits were good. Profits are up. Debt's come down. The dividends off it's a dividend yield of 4%. The valuation looks very cheap on many levels. But you've got, again, it's like a company we mentioned previously. What's the growth profile? What's the capacity? How many more stores in the UK? How many more card factories can you take? 1,058. They say they've got 90 net new stores by the end of 2027. That will bring the estate to 1,148. That's not that much more than where we are now. Is that then capacity? They're growing overseas. They've got a place in South Africa as well. And they're going into baby gifting and pet gifting now as well. That's their expansion area. But how much bigger can this thing get? It's done really well. I think it's a well-managed business that's proven itself. But where's the growth? What's the longer-term growth?
Yeah, I guess that's the question, isn't it? How much growth is left in that area?
Yeah, I
That's
don't
the,
know. I
that's
don't
the
know.
million-dollar question, isn't it? Moving on to HSS Hire. Now, this is an interesting one, isn't it? Because everyone knows them as a hire company, but they've actually developed quite an interesting platform, haven't they?
Yeah, I've dismissed this a few months ago in a equipment rental hire business for the construction sector mostly. And they looked at a bit of a state. They came from the main market to AIM because they needed to go through a vast restructuring. And they've really transformed themselves and debt's come down a lot. This business had a heap of debt and it's now reduced a lot. It was 240 million a few years ago. Now it's down to 150 odd million. They've also relocated. So they used to have a lot of their own sites. They've shrunk that. Now you just have HSS depots within builders merchants. They've sort of linked to the builders merchant sites. But what they've done is they've developed their own platform, their own marketplace. So you as the equipment provider of the equipment can lodge your equipment onto the platform and somebody that wants it can go on that platform to rent it. So it's not HSS doesn't have to own all this equipment and tie up again a lot of capital. It's put money into the technology of the platform. It's quite a radical move. I hope it works for them. It's good. They had to do something. I'm a bit puzzled why they think they have to pay out a dividend when they've still got expensive debt. The dividend yield looks pretty attractive, 7%. Why pay a dividend when you're paying so much in interest? I would prefer them to get their debt way down before they reintroduce that. But well done. A bold move. They're taking a bold move, total transformation of the business. Clearly, the other thing wasn't working. Hopefully, this one works.
Yeah. Do you know if anyone put their tools or diggers or dumper trucks on there, or is it only
I don't know.
reputable companies?
I think they probably have to. I assume they vetted them and to make
Yeah,
sure that they're reputable and the equipment's up to spec and everything and reliable, because that could impact their reputation.
of course.
That bit of detail would it be interesting to look into. It's called Pro Service. This Pro Service offering they've got now. And as I say, it aggregates buyers and sellers across a whole range of products. They sell stuff as well on that, so people can put their stuff on to be sold, not just rental either.
And do you think we're looking at the next Airbnb or Booking.com, the next $80 billion company here?
Not so sure in HSS.
No, maybe
Good
not.
luck to them. Good luck to them. But yeah, it's good. I like the fact they've really done something a bit different. I hope it works.
Yeah, I do as well, actually. I really do, because they've been innovative, haven't they? They've really gone out here and tried to do something different, and fair play. And it's nice to see that.
They went through a near death experience as well a few years ago. So it's a lot better now than it was.
Shall we finish off with Anexo then? And there's a red flag here you want to touch on, isn't it? Something for investors to look out for.
Yeah, Anexo's been very disappointing. It's a business that we've known a while, and we thought things might have changed, and they haven't. It's a specialist integrated credit hire and legal services provider. It's an odd business. It provides services to the impecunious, not at fault motorists. So this is the motorist that gets whacked, and a lot of motorcycle riders that get hit won't have the fully comprehensive insurance and replacement vehicle cover in place, therefore whose livelihood is affected should they not be able to be on the road. So Anexo steps in, typically via an introduction from a repair shop. The repair shop says, look, you've got trouble. I appreciate you got trouble with repairing your bike or your car. You won't be able to go and see it. The guys at one of Anexo's businesses or different brand names, and they'll provide you with a free vehicle to cover you. They'll cover all the costs, and they'll also sort out your legal bills. They'll go after the other party's insurance company for you. So, of course, what happens, Anexo incurs a lot of costs at day zero and ongoing costs and has to chase the insurers to pay up. It is allowed, under law, it's allowed to reclaim market rates, spot rates for the rental of the vehicle or the bike. So there's a quite high rates that's legislated that they can do that following a precedent, and it's been tested in the court. So that's quite robust. So it reports profits, its returns to its services it's providing to these claimants. It records profits. Unfortunately, based on what it's claiming from the insurance company, unfortunately, the profits are far removed from the cash it receives.
So it's claiming profit for what it perceives it will get in based on when the insurance company actually pays out.
Absolutely.
Oh, wow. That's the red flag.
It's recording a profit, a margin. The margins look quite healthy. You think, oh, this is quite a nice business. Look, it's making, 15% operating margin. Had revenue rose 8% to 149 million. Pre-tax profits, only margin low at 23 million. So margins 15%. Oh, wow. The shares are really cheap as well. This business is trading at a really cheap valuation. Look at the cash flow, though. It's got a huge trade receivables. So all these insurance companies owe it lots and lots of money. So
potentially, if it wins the cases, that is.
Generally speaking, it wins.
Yeah.
However, it could take a long time to win. And what happens is the insurers say, so your claim is for 10,000, and then you meet on the court steps and agree to pay out 3,000 or whatever it is.
Yeah.
So it takes its trade receivables and says, no, we're not going to get anywhere near that. We're going to impair them. We're going to reduce them to what is a realistic amount. But even after reducing them, it still has to wait for months, years potentially to get paid. So it has this huge receivables, what it's going to be paid, and that it has to wait for. It's also been involved in other cases it's been involved with the VW emissions case. So it received a payout on that. It represented a lot of claimants for the diesel emissions, Dieselgate, they called it. It's involved with lots of other car companies as well. So it's had a payout on that, and it's going to wait for other payouts on Mercedes and other motor manufacturers. But it's a real example of when profits flatter and when cash is absolutely king. So focus on the cash flow, because this business cash flow has been really constrained. It's almost gone full circle, and it's turned into one of its own clients. It just hasn't got any cash. It hasn't got the resources that it's supposed to, and it's reliant on very expensive debt. That's the real shame as well. However much its cash flow improved, and it said its cash flow improved, the cost of servicing its debt is tremendously high, so its debt doesn't come down much by the end of it.
So has this company primarily then been funding itself through debt to keep it going while it's waiting for the
It has, yeah.
receivables to come in?
It's been debt funded, and again, it's another one. Why is it paying a dividend? It's paying a dividend. Clearly, its founder shareholders own a lot of the shares still, probably like the dividend, but the dividend's going to cost it 1.8 million quid. It better save that and to pay down its debt. I mean, its debt's costing it nigh on double digits percentages. It's just ludicrous to mine. Yeah, so it's frustrating. Because when it first joined the stock market, I think there was the intention to get the cash to generate the cash flow, bring it in faster. And that's not happening. I think, being drastic, this business, the best thing it could do is to almost get into wind down, because its net asset values, because the value of its debtor book is so much greater than its market capitalization. Its net assets are 160 million pounds, and the value of the business is 74. So it's worth double. The net assets are worth double the market capitalization. If it went into wind down and never collected any more claims, never secured any more clients, and just focused on getting the cash in, shareholders conceivably would be better off.
When you say it's net assets, so that's actually the insurance claims that it's got on its books. They're just waiting to be paid. Is that what you mean?
Yeah. So what the insurers owe it, that's
Right.
effectively what it's made up of mostly. That add the cash, less all
Various
it's
other
due.
bits as well.
The net value of the business on its balance sheet is more than twice what the value of the business in the stock market is. So if you bought the shares now, conceivably, if never represented another client and simply concentrated on getting the cash in, it could prove better value almost. It sounds quite harsh, but that's the sum of it.
To use your example earlier, though, I guess that's presuming it gets what it perceives that it's owed, because it's probably booking, oh, well, this particular claim is worth 10,000 to us. But actually, the insurance company has to settle at that, doesn't it? And as we know, insurance claims will negotiate or bargain, won't they? Well, we perceive it to be worth
That's
six.
what it's saying. It's already done that, but it's a good question. Has it done that to the right extent? It's already accounted for a huge impairment. It's saying,
Oh,
no,
so
we're not.
that's already built
It's
in,
already,
is it?
it's already
Okay.
said that. However, is it realistically
Yeah.
actually what would happen? Would
Whose
that be
impairment? Their view or
Yeah.
the insurer's
That's the problem.
perspective.
The impairment's massive they put through already, but could it be even greater? Could the amount they actually get at the end of the day be even less than what they've impaired the value to? That's who knows. Probably more to it than what we're describing. To some respects, it does a decent job supporting people that have no other means of getting a claim through. But yeah, it's a worrying business model. It really is. It's a horrid business model, having to wait so long for cash. And business is all about cash.
Yeah, I've got to admit, when I read through this, I was a bit like, oof, not so sure about this business model. It doesn't quite sit there as well as some of the others we've discussed on here.
No, sadly not.
Well, that was another long one. We may have gone over the 30 minutes there, Chris, but hopefully plenty of good information, plenty of good insights. And yeah, thank you very much for another great episode.
Always good, always fun.
Well, that's it for today. Please subscribe for next week's episode, as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics, and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.